Well, good afternoon here in London and good morning in America. And we are absolutely delighted today to welcome not just an expert, but one of my dear friends, Byron Gilliam, who is dialing in from North Carolina and is going to be our expert today, talking to us about stable coins. Today's title is Stablecoins, Crypto's Killer App or the Killer of Crypto's Investors. Byron has a most interesting background, and you've read it, but the soft side of it is he was my neighbor and my friend, and our kids went to school together. And then he blasted off away to France and then back to America, and I miss him. But the biggest thing is he took on a brand new career, moving from high-end strategist and trader. He decided to cover crypto for a company called Blockworks, and we're delighted that Blockworks have allowed him to speak here today. And at Blockworks, he's basically become their newsletter author. And every single day you can read Byron's work on Blockworks. And what I've watched is him transform from being a very good writer to being an excellent writer. It's been a real delight. And somebody who really hates reading other people's writings, I think it was Gore Vidal who said something along the lines of every time somebody else is successful, one of my friends, a little part of me dies. And I watch Byron there. Getting better and better, and I wish I could follow him. But anyway, enough of mutual admiration. We'll just move on quickly. You know me, I'm Michael Mainelli, one of the directors of CN, and always delighted to introduce these fascinating webinars. But I can only do so thanks to the tolerance of our various sponsors who allow us to range widely and freely in technology, economics, and finance. And what, since 2009's issuance of BTC, Bitcoin, has taken the attention of so many people, but cryptocurrency. Now, many of you will know that on a scale ranging from kind of, is it a Ponzi scheme to is the future of everything in the entire universe, I'm a bit on the Ponzi scheme end of life, but even I have been captivated. Xian's been involved in the technical space since about 95 when we built our first blockchain. Check that one, true, and we've got all the background there on our website. But the application of crypto was a new one. And Byron has gone into this space, I think, with an open mind, a broad mind, and we're looking at what he's doing there. So today, the program, as you'll know, is one we've seen many times before. My job's to get out of the way so you can hear from somebody who knows what he's talking about. Second thing is Byron's got about 20 minutes to lay out the case for stablecoins, and please do pay attention because he has thought about this carefully and isn't promoting any one view or the other. And then you've got 20 minutes to ask him as much as you like. And to get things going, we just thought we'd ask a little poll about how you felt about cryptocurrencies themselves. So is crypto, and I'm just about to launch that poll there, to you, is it a Ponzi scheme, a slow motion car crash, the next iteration of finance, a fundamental pillar in the future of finance, or is it just a betting circus? Now, Byron, the great thing about our group here in FS Club is that if they're not quick in answering, they're certainly opinionated, and well over half the audience has voted, almost 75%. So I'll leave that open for just another 5-6 seconds while they get their votes in, and we'll give that a quick close and have a look with virtually all of the audience having answered. Oops, there we go. We can see those results there. So actually, unlike me, much of the audience is positive about it, but some think it's a car crash. Nearly 50% think this is where finance is going, and a quarter think it's a bit of a betting circus. So you've got, I think, here a bit of a split audience, Byron, one that seems to see sort of both sides. But anyway, Byron, let's start with this one. The floor is definitely yours. Over to you.
Great. Thanks for having me. That was an amazing intro. Thank you, Michael. And it's really neat to be here. This is definitely a long-time listener, first-time caller situation. So thanks very much for having me on. So stablecoins. What's so interesting in stablecoins? That was a pretty friendly poll response. I thought I was going to have maybe a more antagonistic audience, so maybe I don't need to sell it to you guys, which wasn't my intention anyway. But stablecoins, I've always thought were maybe the most interesting part of crypto, and surprisingly, they're getting more interesting. Relative to the rest of crypto. For one thing, the very first line of Satoshi's white paper pitched crypto as an a version of electronic cash that would allow online payments. And Bitcoin itself has not done a very good job of that. You can't really, buy much with Bitcoin other than other cryptos, and not even that very effectively. But stable coins are getting there. Stable coins are becoming the payment choice or the payment method of choice. And in that sense, are sort of realizing that original vision. They're also the last narrative standing in crypto at the moment. You know, the original case was store of value, and then it was an inflation hedge. We've seen how badly that's worked out this year. More recently, we've had narratives like e-gaming going onto blockchains and NFTs, and those have both not really panned out the way that we hoped it to. So stablecoins at the moment are looking like the best and most successful use case for crypto. So it's interesting for that reason. And then finally, oh no, sorry, not finally. It's also the best business in DeFi. You know, we especially clear this week is that we thought that the best business in DeFi was exchanges, and that seems to not be the case as of yesterday. So stable coins are really the best business in DeFi in terms of the issuers. You know, they issue stable coins, you give them cash, and then they deposit the cash. You know, they invest in treasuries and make a return. So, you know, being a stable coin issuer is a really good business, probably the best in crypto. But it is also the Achilles heel of DeFi, which we'll get into a little bit later. But that was made most clear recently with the Tornado Cash sanctions from OFAC. So if we can go on to the next slide. So just to start from the beginning, what are stablecoins? This is a surprisingly difficult question to answer. The CEO of Circle, which I'm a big fan of, Jeremy Allaire, he describes USDC, his stablecoin or their stablecoin, as tokenized cash. I'm not sure that's 100% correct, but it's probably just as correct as these other definitions. You could also describe stablecoins as an on-chain money market fund or a share in an on-chain money market fund. Just last week, JP Morgan said they had tokenized bank deposits. So you could say that is a way also to think about stablecoins, especially if the stablecoin is being issued by somebody like JP Morgan. Or you can take a more general definition and call them digital dollars. I would say digital dollars is probably the least correct of these four, but it's probably also what I would have answered if you asked me the question, because each of these, none of these other definitions are entirely correct either. Next slide. So what are the different types of stable coins? They've been multiplying. The one that you're probably aware of is the fiat-backed stable coins. That's Tether, the sort of notorious one that you've probably heard about from negative press reports, and Circle's USDC, which we just mentioned. Those are probably also the easiest to understand. You give Circle or Tether a real dollar, and they give you back in return a digital dollar. And then they take that dollar and they buy treasuries with it, or in the case of Tether, we don't totally know what they buy with it, but they buy something and they make a return. And then when you want your real dollar back, you give them your digital dollar and they give you your real dollar back. That's in theory and how it's worked out so far. So that's, and you can see on the chart on the right, those are the two biggest. The dark purple at the top, that is Tether. That's Tether's market share, and the lighter shade of purple is USDC. It's kind of interesting that Tether has been winning market share from USDC recently. You can see that dark purple part at the top has been expanding. I think we're going to discuss that on a further slide. But anyway, those are the two biggest ones. The other types are collateralized debt position stable coins like DAI. DAI is the biggest, issued by Maker. That in turn is mostly collateralized by USDC, which makes it a little bit of a problem. Some people refer to DAI as wrapped USDC, which is sort of a dig at what they're doing. But the idea there is that you give them some collateral, preferably a crypto collateral, and they give you back a dollar that's backed by that collateral. Now we get to the most notorious ones, the algorithmic stable coins. That, of course, was what Luna Terra was. Sorry, Terra Luna. UST was the ticker for their stable coin, which famously blew up earlier this year. There is in that case, there was no collateral, at least in the beginning. He tried to do a quant and tried to quickly collateralize it, but it was too late. But that was a stable coin backed by a crypto, which itself was not backed by anything. So that's an algorithmic stable coin. There is a more successful version of that, which is called Frax, which is only partially collateralized by another crypto. It's mostly got real collateral, which is again mostly just USDC, but that's algorithmic. There are yield-bearing stable coins. I mention this mostly because the biggest one I think is MIM, and I just wanted to mention MIM because MIM stands for Magic Internet Money, which I think is just the best name for a crypto that you could possibly have. But for those, you generally deposit some collateral, and that collateral earns a yield, and they pay you that yield as opposed to Tether and USDC, where they keep the yield for themselves. The yield-bearing ones, you deposit some collateral and you collect that yield yourself. The newer type of stablecoin, or actually these have not actually really started so much, but they're in the works, are protocol-specific stablecoins. Aave is the most prominent one. Their coin, which hasn't been launched yet, is going to be called Go, G-H-O. And the idea there is that they are going to be issuing stable coins against their lending pools, which kind of is going to make them sort of a free bank issuer of money, which is just intellectually interesting. I don't know how much of a success it'll be, but it's fun to think about. And then there are bank-issued stablecoins, which I just mentioned on the previous slide. JP Morgan just last week said that they had tokenized their own liabilities and put them on chain. So that was just a pilot in Singapore. But in theory, you could get every commercial bank starting to issue their own stablecoins. Probably not in the US because they won't allow that as of yet. But that could be the next generation of stablecoins, issued by commercial banks. And then there are flat coins, which is a term I think was just invented 2 weeks ago, and I've got a whole slide on that, so we'll discuss that in a couple of slides. So if you want to advance from there. So yeah, so you can't have a discussion of stablecoins without talking about Terra Luna. I added this picture because it's just so amazing that Mike Novogratz, who's a TradFi veteran and a super smart, sophisticated guy and total insider in crypto, even he was totally taken in by it, to the extent that he got this gargantuan tattoo that he will never live down. In hindsight, it seems like Terra was just an old-fashioned Ponzi. I don't think it was that. I don't think it was that simple. Everything. It actually, everything that happened was, transparent in the docs. What it actually did, what it was supposed to do. UST, the stable coin, was collateralized by demand for Luna. And Luna itself was just collateralized by people's belief in Luna. There was nothing to it. And when that belief ran out, then UST itself collapsed, which in hindsight should have been pretty obvious, and it shouldn't even have been that hard, without hindsight, because the exact same thing happened a year prior in Iron Finance. It's really, it was just a rerun on a larger scale of what happened to Iron Finance. It was kind of funny that we had to learn that lesson a second time in such a short amount of time. But I think the reason for that was because the industry is really just desperate for a truly crypto native digital dollar that is fully decentralized. I'm quoting Do Kwon here. Do Kwon was, of course, the founder of Terra Luna. And the quote is, "What are we even doing here?" And he was referring to, if crypto cannot create a decentralized stable coin, then what is the point of all of this? And I think it's a fair question. Next slide. Okay, so this is the two fiat-backed stablecoins, Circle and Tether. As we saw in that chart earlier, they are they have by far the largest share of the market. And it's interesting to think about the contrast between the two. So USDC is highly regarded. They are properly audited and they are properly regulated, and everybody it trusts them. I would say that they are the most trusted institution within crypto. And Tether is the opposite. Tether is very lowly regarded. We've been waiting for years for them to issue a proper audit. There are like questions about where their headquarters even are. Like, I'm not even sure that we know where they're headquartered. And yet Tether is still the largest stablecoin by market cap, as we saw on that earlier slide. And as of recently, they were even gaining on USDC, which is kind of crazy. USDC has been seeing some redemptions lately. And the question is, why has Tether been more resilient than well, the question is, why does Tether still have a larger market cap than USDC? That kind of drives traditional finance people crazy. And there's also a question as to why Tether has been more resilient than money market funds in traditional finance. If you think about in 2008, the Reserve primary money market fund is what sent the financial crisis into its acute phase, and that happened when people realized that the Reserve money market fund held 1.3% of its assets in Lehman commercial paper. So just the thought of a money market fund losing 1.3% was enough to send traditional finance into panic, and yet Tether has clearly lost more than that. They haven't fessed up to it, but it's obvious just from looking at what they've said. It's clear that they've lost 3, 4, 6% of their assets, and it just drives traditional finance people totally nuts that people don't seem to care. The crypto people don't seem to care, and I think it's an interesting question to think about why. I think there's two main reasons. One is that you have to remember that Tether is a money market fund that keeps the yield. They don't pay the yield out to holders of Tether, and that's a very profitable business, especially now with interest rates at 3, 4%, whatever they are. So I think holders of Tether are assuming that Tether the company is redirecting some of that yield into the reserve. So okay, yeah, we might be 3, 4, 5% underwater, but Tether is going to make it good with their earnings. We don't know that they're doing that, but I think that holders are trusting that they are doing that. And then I think the other thing is that crypto holders know that Tether is a little bit sketchy, and they know that it's not exactly cash that they're holding. When people were invested in the Reserve primary fund or any money market fund, they just assume that it's cash. Like a money market fund is just synonymous with cash to people. So they when they find out that they might be losing 1.3%, that's just a total shock to their system. Whereas with Tether, it's not cash. It's a little bit shady, but it's convenient and useful, and they're probably going to do the right thing, and that's good enough. Next slide. Yeah, so use cases. That is always the question for crypto as a whole. And I would say for crypto, stablecoins so far are the best use case. but what are the use cases for stable coins themselves? The most direct use case is that you trade cryptos with it. You know, every cryptocurrency basically is paired against a stable coin when you want to go anywhere, be it a centralized exchange to trade it or a decentralized exchange. The one side of the pair is going to be a stable coin. Some other use cases are, you know, that's very that's very insider baseball. Like that's, you know, it's only useful if you actually care about trading other cryptos, right? So what about the rest of us? SBF, I did this slide before FTX collapsed yesterday, but SBF has said that he's bought whole companies with stable coins, which I think is kind of interesting, like, you know, because stable coins, you transfer them to, you know, from your wallet to somebody else's wallet, and you know, that's a little bit different than going into a lawyer's office and sitting down and sending your money to escrow and stuff like that. But you know, that's one use case of stable coins. You can buy companies with it, and even regular people, you can invest on Angels List. If you're you know, you want to make some seed investments, they will accept stable coins. So there's some like real niche use cases for that. The more hopeful use case is that people in places like Venezuela and Lebanon, they've been able to use stable coins to opt out of their local currency. And you know, a lot of those currencies are hyperinflating, and the ability to get digital dollars has been, you know, has been a life raft for a lot of people in those countries. And there's some interesting cases, particularly in Venezuela, of you know, stable coins catching on to the extent that people are even getting paid in stable coins and being able to, you know, pay their rent in stable coins, so they're you know, able to opt out of the local currency entirely. Although that's a real niche use case that hasn't caught on with the mainstream yet, but it's hopeful that it gives, you know, people in those types of countries an option. Next slide. This is the best slide, obviously. This is referencing the eternal coin, which ZN was talking about well before crypto was even a glimmer in Satoshi's eye. I put this up here, you know, one, because it's you know, it's fun that ZN has been thinking about it for so much longer than all the rest of us. But two, there's a couple of stable coins that that are recent inventions that I think are really interesting. One called Nuon was just out, like, I think just like 3 weeks ago they announced it. They say they have developed a stable coin that is pegged not to the dollar but to the cost of living, and they call that a flat coin. The implication that your coin will be, you know, always worth the same, will always have the same purchasing power now and in the future as it does now. I've looked at their docs. I do not understand at all how they think they're going to manage that, but I think it's just interesting and fun that they're at least trying. There's another one called FPI, which is a little bit older. That's a frac stablecoin, and they've pegged that against not the cost of living, but the CPI. You know, CPI is just a statistic, but they have pegged their stablecoin to CPI. So far, it's been working. I don't really understand how it's working, and I'm not convinced that it's going to continue to work. But again, I think it's just really fun that they're trying. And I think it's also worth maybe paying a little bit of attention to, because in theory it could work. You know, there's another theme in crypto is tokenizing real world assets, and if that is another thing that I'm a little bit skeptical of. I'm not really sure how that's actually going to happen, but there are a lot of super smart people working on it, and if real world assets ever do genuinely get tokenized and tradable on chain, then you could, in theory, back a crypto token with the basket of those real world assets, and that would presumably track the cost of living, kind of like this picture with you know, the so many guys, seven, you know, the picture of that coin with seven slices in it. You could design your own crypto, put, you know, the seven the 7 real world assets that you care most about into that coin, and there you've got the eternal coin. That's that's pretty pie in the sky. I'm not sure that will ever happen, but I think it's neat that people in crypto are working on it. Next slide. Okay, so this is at the top. I referred to stable coins being DeFi's Achilles heel. This was a big theme about a month or two ago when OFAC, the U.S. Treasury, added a number of addresses from Tornado Cash to the OFAC list, and people suddenly realized that it would be very easy for the U.S. Treasury to shut down all of DeFi just by adding a handful of smart address or smart contract addresses to the OFAC list. And the realization that people in crypto suddenly had was that we as an industry are entirely reliant on centralized stable coins like Tether and USDC, and that those coins in turn could be shut down by the Treasury via OFAC at any moment. So, at the same time that stablecoins have been the most successful part of crypto and the best use case for crypto, they are also the way that the government can exert its control over crypto at the same time. Next slide. Yeah, so the holy grail of crypto, the holy grail of stable coins would be to be genuinely decentralized, and that would eliminate that OFAC risk that we were discussing in the previous slide. Unfortunately, nobody's figured out how to do that as of yet. The one thought is that you could have floating stable coins. So the reason why centralized stablecoins are the biggest stablecoins is because it's seemingly impossible to peg a stablecoin to the dollar without being centralized. So one solution would be to well, let's not have it strictly pegged to the dollar. Let's let the stablecoins float. To me, that's oxymoronic. I mean, if it's floating, then it's not actually a stablecoin. But people are trying. Rye is a stable coin that was I mentioned mostly because it was pegged not at $1 but at $3.14 just for fun, I think, just because it's because crypto people are math nerds, and it was just funny to peg it to pi instead of to $1. But it is soft pegged, so it avoids that centralization risk by not being strictly pegged, but then you've got a dollar that is worth different things at all different times, which sort of makes it not a dollar. Another attempt at being truly decentralized was Olympus DAO, which was which most people would describe as a Ponzi. I think it was not technically a Ponzi because, again, it was pretty transparent in what they were doing. But that attempt at a type of stable coin was to back the coin with a basket of crypto assets, which were themselves decentralized. But again, it was just you couldn't peg it at $1. It was just wildly volatile, which makes it kind of useless as a currency. And then the biggest decentralized stablecoin, DAI, which is issued by Maker. They recently, or DAO holders recently took a vote, or DAO members took a vote and agreed on the end game, which is a proposal by one of the co-founders, which is going to remove the hard peg. It's going to depeg DAI from the dollar in the long term. This is, whether it actually happens or not. But the plan is that it would depeg over the next few years in order to make it censorship resistant, which, great, censorship resistant is great, but then if it's depegged, then what is it? I don't know. It's no longer a stablecoin. And I mentioned that just strictly because it is such a difficult question for DeFi that people are kind of grasping at straws at this point.
Byron, we've got a lot of questions, so we'll just kind of pull it together if we could.
Okay, yeah, let's speed it up then. The next, so just quickly, what's new in stable coins is that TradFi interest rates are now higher than DeFi interest rates. It used to be that money was coming into DeFi for the higher rates. Now that Powell has been raising rates to 4%, now the money is going back out the other way. And the other new big thing was mentioned earlier that JP Morgan has tokenized bank liabilities, which could be the next generation of stable coins. And then I just list some things that could happen on the penultimate slide here. We could see commercial banks issuing stable coins against central bank reserves. I don't know if those would still be stable coins or those would just genuinely be digital dollars, but that could be a thing in the next year or so. Could be that fintechs are given access to Fed master accounts. So that would be like if Circle were able to have an account at the Fed, which would be sort of like a private sector CBDC. It could be that stablecoins entrench the US dollar as the world's reserve currency. There's a lot of demand for dollars in the world, and stablecoins is one way to service that. If DeFi really scaled, which doesn't seem like the case at the moment, but if it did, it could be the case that stablecoin issuers at some point corner the T-bill market by just buying up all the collateral, which could cause trouble for the rest of traditional finance. Could be that stablecoins become the next euro dollars. Could also be that regulators put the kibosh on the entire thing and just shut it down. And then the bank run question mark. We had a bank run in crypto yesterday on FTX. It could also be that we do finally get the bank run on Tether that everyone's been expecting. That's an ever present risk for crypto. And then I think the last one, we're just summing it up.
Well, that's great.
Yeah. Just quickly, some things that we've learned from stablecoins. Just one is just that people really want dollars, even crypto people. People do not want their assets denominated in Bitcoin and Ether. They want dollars, and that's why people like stablecoins. They don't have to be particularly good dollars. Tether has shown us that they can be pretty lousy dollars, and there'll still be plenty of demand for it. This one's really disappointing to crypto people, is that people don't care much about decentralization. Most people in crypto, or most crypto holders, are pretty happy with Tether and USDC, even though they are not decentralized. Another one we just described in that previous slide about how it's extremely difficult, if not impossible, to peg something to an asset without holding that asset. That is the central problem with the centralization of stablecoins. And then finally, just to bring it back to the very beginning, the original promise of crypto, and that from that first sentence of Satoshi's white paper, it's taking absolutely forever to realize, and we're still not quite there yet.
Excellent. We got tons of questions, so we're going to have to be quite staccato here. But I think you're absolutely right, and I love your opening there. It's we've been through a whole series of narratives: not a store of value, not an inflation hedge. As we're on to stable coins with a few specialist areas like gaming or NFTs floating around. So super stuff. Quickly, Nikki Holzhausen, what's your view of CBDCs, central bank digital currencies, versus stable coins?
Yeah, I'm probably not I'm not as well informed on CBDCs as I should be. I think for me, the best outcome would be simply if either commercial banks were allowed to issue their own stable coins, or if fintechs like Circle were given access to Fed master accounts. I don't think anybody really wants the US government issuing their own stable coin. which is effectively what a CBDC would be. But I think it could be, really good certainly for the crypto industry if commercial banks or fintechs were given access to Fed master accounts, and you could genuinely count on those dollars being dollars. But it would also, I think, be good for the economy. Stablecoins settle T+0. Which means that the velocity of money can be higher, and higher velocity of money is more efficient for the entire economy. So that would be my preferred outcome.
Anthony Abel loves your presentation. He's what about tokenized, regulated, enumerated legal titles of property trading on a property exchange? Any thoughts on that kind of backing? Because that, of course, was on the Eternal Coin slide. That was one of the, in fact, if you looked at the whole report, the conclusion of our report 12 years ago was that actually land was probably it.
Yeah, I'm a little skeptical on that. There was a fun thing from 2 or 3 weeks ago. There was a house that sold on OpenSea. OpenSea is the big NFT trading platform. At least, the headlines were like, house sold on OpenSea. To me, that's not exactly what happened. First of all, it was an LLC. What was exchanged on OpenSea was represented an LLC, which in turn owned a house, which is not exactly the same thing. But also, even did the LLC itself, did it really change ownership on chain? Or to me, it didn't change ownership until some lawyers signed some papers off chain. So the only thing that is happening on chain is bookkeeping, basically. It's a representation of something that's going to happen off chain. So, yeah. And I think blockchains can make for better bookkeeping, but it's still going to be bookkeeping. It's not like a 0 to 1 change, in my opinion.
Yeah. And as Anthony points out, it's not recognized as legal title either. But let's move on a bit. Charles Vermont, and I must say I'm a bit here, particularly on Tether, where, okay, so I'm now taking my stuff out of one crypto. Maybe the purpose is to go trade another. And then I'm putting it into a rickety basket, which is not transparent, which has had its own problems, blah, blah, blah. So Charles's point here is, why invent a new way of making payments when the old ones still work perfectly?
Well, I mean, I wouldn't say the old ones work perfectly. As said, stablecoins are T+0. It's costs a lot of money to wire somebody, just to send somebody a bank wire. ACH is really slow. And you have to have a bank account. There are billions of people in the world who don't have bank accounts, right? So if you can offer them dollars on a digital wallet, they probably do have mobile phones, right? So if you can offer them dollars on a mobile phone and give them the opportunity to exchange it, for goods and stuff, that would be a massive improvement, for the world. And then there's also, you could also, if JP Morgan genuinely tokenizes their liabilities, if banks can start trading with each other on a T+0 basis, that's a massive improvement as well. So I do think, stable coins are a genuine improvement over the state, the current state of payments. But it's, it's still a ways to go before we realize that.
Andrew Ballard's curious. He's a DGED. Do you know anything about DGED, which claims to be an autonomous bank on a stablecoin contract?
DGen, that's the name of a bank? I haven't heard of that. Like, DGen is the phrase for people who like to gamble in crypto.
DJED.
Oh, sorry. Oh, EJED. I don't know that one. No.
Okay, that's fine. Ian Sheridan, who's actually doing Ian's a barrister, is doing a talk for us next week about regulation of stablecoins. Byron, given crypto gravitated to stablecoins, is there a future where crypto is most suitably part of the derivative subsector?
It's a part of the derivative subsector in what sense?
Financial services,
I don't know. I haven't thought about that one yet. I would assume that stablecoins are going to be the most regulated part of crypto, and probably, and also the most easily regulated and the part that should be most regulated. I haven't thought about them in relation to derivatives. I'd have to give that some thought.
Yep. Now, you mentioned in passing, and for those who aren't tracking the markets on a daily basis, we had CZ, Changpeng Zhao, and SBF, Sang Bankman Fried, where CZ is Binance seems to have taken over SBF's FTX. And we've also noticed in the last 48 hours or so, Bitcoin, even on the course of that, has fallen nearly 30%. What's the impact of that likely to be? Is this just yet another one of those sort of not quite Ponzi schemes, or is this ultimately sort of fatal to the whole environment?
Yeah, I mean this is brand new. It just happened yesterday, so all those things are certainly up for debate. I think in traditional finance terms, I would guess that this is our Lehman moment. So we had our Bear Stearns moment with Luna and Three Arrows Capital about 6 months ago. It's funny how the timing is nearly exact. And I think now we're having our Lehman moment with FTX. If you're in crypto, it is a genuine shocker. Like it's just really amazing that it could come to this. Um, if you're out of crypto, I don't think it matters. Like there's no systemic threat from FTX or anything like that. It's worth remembering that this is all CeFi. This is centralized finance. This is not a DeFi problem. The issue to DeFi is just simply that CeFi provides the rails for people to get into DeFi. Binance is coming out as a big winner. He's clearly the final boss of crypto and at least of CeFi. So I think at the end of the day, it will be okay, but it is definitely shaken everybody's confidence, and there is a lot of contagion risk that could still play out. But I don't think it's an existential threat to the industry. As of now, but there's a lot there are more shoes to fall for sure.
Mm. Ian Sheridan also here, just a quick, if you don't mind, but you mentioned in passing perhaps USDT, Tether is not fully matched by fiat USD. Have events over the last couple of days changed the actual or perceived situation there?
Well, Tether's been getting inflows since yesterday because it's funny to think of Tether as a beneficiary of a flight to safety, but that's what it is at the moment. People are selling cryptos and buying stablecoins. So in the very short term, it's a beneficiary of the chaos. I don't think it'll be any existential threat to Tether either. Yeah, short term it's a beneficiary, long term it's probably neutral.
Okay. Jeremy Light's curious, cross-border payments in USDC and USDT weren't on your case list, and he contends that they're cheaper and immediate compared to traditional methods. How big is this use case, and is it growing?
They should have been on my list, for sure. That's the original idea, from my memory, the original bull case for Bitcoin or the use case for Bitcoin was that it's cheaper than Western Union, and that's and stable coins kind of are. I don't think it's a very big use case at the moment, but I think it potentially could get a lot bigger with the advent of layer 2s on Ethereum, which are going to make transaction costs just very nominal, fractions of a cent, and hopefully with that, the payments use case will catch on. There's also some issues, you got to sort out self-custody, and there's all this big CeFi mess. So there are other issues, but I think it's a very good use case, and hopefully it'll get bigger.
I'm just going to launch a poll here, folks. So, which is, you've listened to Byron and lots of good questions, which we'll get on. But, what do you think? Is it tokenized cash, on-chain money market, tokenized bank deposits, or digital dollars? While the folks are answering that, just quickly here, Charles Vermont is curious about what you think about gaining yield by lending stable coins, to one another on diversified exchanges. It's interesting as well that Clive Bullen is curious, would you advise individuals in the general public to put their money into stable coins? So for example, to do that kind of lending. And Hugo Innes is curious about, what's the story with stable coins in a non-zero interest rate environment?
Yeah, those questions are all related. So the yield that you can get on stablecoins now is very, very low, and so there's really no point doing it. People are going in the other directions. People are redeeming their stablecoins for cash and buying treasuries. You can get, I think I bought the Vanguard short-term bond fund the other day. It's yielding 4.7% or something like that. So, and you can't get 4.7% for your stablecoins in DeFi. So there's no point at the moment. I also generally wouldn't recommend it to people because it does get complicated. It's just easy to make mistakes and lose your keys and send it to the wrong place. So, unless you're really dedicated to it, I wouldn't particularly recommend it.
Okay. Well, look, you can see here you've left the audience about as bemused as they were when they started. It's almost sort of equal portions of the four possibilities, with tokenized cash gaining the most market share, but not by that much, really.
I think they've got it exactly right, because it could be any of those, really.
Yeah, no, that's absolutely excellent. Well, look, just in terms of a wrap up, if I may, I mean, I've enjoyed this. I do recall some of the really great things when people are trying to summarize, what's happening out there. And I love the description of Bitcoin, which I think came off of Twitter somewhere. Imagine if keeping your car idling 24/7 produced solved Sudokus you could trade for heroin. And I'm still as baffled as I ever was about these. But I think, the point here is that a lot of bright people are looking at a new technology that may be just a technology looking for a solution. And we, I think, in some ways are contrasting it with an existing very old system and not realizing this is kind of blue sky research. And if we were looking at a new material in the science lab, we might be saying, scratching our head, what's good is it? And I recall that as recently as with graphene, which had virtually no purpose and is now being touted as a new super material. And I could go on about things like that. Folks, there's several things here to wrap up with you. Firstly, an immense round of thanks to all of you. Really vibrant questions. They will all be sent to Byron and he can answer them if they wish. Secondly, we've put quite a few things into the chat room there, bulletins that we've got on the subject, the Eternal Coin publication itself, but also do check out the chat room, because Byron's daily newsletter you can sign up for, and it's also on the website. Finally, obviously, I have to thank you, Byron. It's been a real delight to see you here. I miss you over here. I hope you come back, do some pizzas together at some point. But thanks so much, and we're looking forward to everybody joining us on many similar subjects in the future, not least next week with Ian Sheridan on lunatics and unstable coins. And Byron, we hope perhaps we can get you back sometime across the water to update us on what is an exciting area.
Anytime. I'd love to.